Welcome back to our channel, where we will be diving deep into the terminologies that are essential to help you get ready for your financial certification exams like investment funds and Canadian securities. Whether you're gearing up to tackle your exams head-on or just looking to boost your financial vocabulary, you're in the right place. Don't forget to hit that subscribe button and ring the notification bell, so you never miss an update from us. As always, remember to like, comment, and share your thoughts. Now, let's begin. Floating rate. A floating rate refers to the interest payments specified in a contract that are not fixed but rather based on an established benchmark rate, such as the prime rate. For instance, in a loan or bond agreement, the interest rate may be set as a certain percentage above the prime rate. This means that as the prime rate changes, the interest rate on the loan or bond will also adjust accordingly. In simpler terms, a floating rate is like a variable interest rate that can go up or down based on changes in the chosen benchmark rate. It provides flexibility to borrowers and investors. Floating rate preferred. A floating rate preferred stock is a type of investment where the dividend payments can change in response to shifts in interest rates. When interest rates go up, the dividend payments on these stocks also increase, and when interest rates fall, the dividends decrease. This flexibility allows the dividend payments to adjust to prevailing market interest rates, making them a potentially attractive option for investors seeking income in changing interest rate environments. Floating rate securities. Floating rate securities are a specific type of debt investment that provides a degree of protection to investors when interest rates are highly variable or volatile. These securities are designed so that the interest payments they offer can change periodically in response to fluctuations in market interest rates. For instance, if interest rates are on the rise, the interest payments on floating rate debentures will be adjusted upward every 6 months, helping to ensure that investors receive a competitive yield. Floor trader. A floor trader is an individual who works on behalf of a brokerage firm that is a member of a stock exchange. Their primary role is to execute buy and sell orders for both the firm and its clients directly on the trading floor or designated trading area of the exchange. Floor traders play a crucial role in facilitating the trading of securities by executing orders in real time and helping to maintain market liquidity. Forced conversion. Forced conversion is a situation that occurs when a company's stock price increases to a level above the predetermined conversion price of a convertible security, such as convertible bonds or preferred stock. In this scenario, the company has the option to require the holder of the convertible security to exchange it for company shares. The holder is then compelled to convert the security into common shares, typically because it's financially advantageous for them to do so. Foreign bonds. Foreign bonds are debt securities issued by a company in one country but denominated in the currency of another country. These bonds are issued by foreign entities in a market that is not their home country's domestic market. For instance, if a Canadian company issues bonds in the United States and denominates them in U.S. dollars, these bonds are considered foreign bonds, sometimes referred to as Yankee bonds. Foreign exchange rate risk. Foreign exchange rate risk, often simply called currency risk, is the risk that an investor faces when investing in assets denominated in a foreign currency or assets that generate income in a currency other than their own. This risk arises from the possibility that the foreign currency may depreciate in value relative to the investor's own currency, leading to potential losses when converting foreign currency returns back into their home currency. Foreign pay bond. Foreign pay bonds allow Canadian investors to diversify their investments and potentially benefit from changes in foreign exchange rates. This means that the returns from these bonds can be influenced not only by interest rates but also by currency exchange rate movements. It's a way for investors to potentially gain from currency market dynamics while holding a Canadian-issued bond. Foreign pay preferred. Foreign pay preferred shares are a type of preferred stock where the dividends are paid to shareholders in a foreign currency rather than the currency of the issuing company's home country. These shares provide investors with the opportunity to receive dividend payments in a different currency, which can be advantageous if they have specific currency preferences or want to diversify their income streams. First in, first out, FIFO. First in, first out, FIFO, is an inventory management method where the items or products that were acquired or produced first are the ones sold or used first. In other words, the oldest inventory is considered to be sold or used before the newer inventory. FIFO is often used to calculate the cost of goods sold, COGS, and to manage inventory valuation for accounting and tax purposes. It assumes that the oldest items are the ones sold, which can have implications for profit calculations and tax liabilities, especially in industries with fluctuating costs or inflation. First-order risk. First-order risk, also known as systematic risk, refers to the exposure that an investment or portfolio has to overall market movements in asset classes such as equities, fixed income, currencies, and commodities. It is the risk associated with broad market factors that cannot be eliminated through diversification within those asset classes. This type of risk is inherent to the entire market and is beyond an individual investor's control. First mortgage bonds. First mortgage bonds are the highest-ranking debt securities issued by a company. They have a senior claim on the company's assets, earnings, and undertakings. In the event of bankruptcy, the holders of first mortgage bonds are the first to be paid from the company's assets before any unsecured current liabilities, such as trade payables, are settled. This seniority provides added security to bondholders, making first mortgage bonds less risky compared to other forms of corporate debt. It is an attractive investment for bondholders seeking safety and lower risk in their fixed income portfolios. Fiscal agent. A fiscal agent is an investment dealer or financial institution that is appointed by a company or government to provide guidance and assistance in financial matters. One of the primary roles of a fiscal agent is to manage the underwriting of the issuer's securities. This includes helping with the issuance and sale of securities to investors, ensuring compliance with regulatory requirements, and providing financial advisory services to the issuer. Fiscal policy. Fiscal policy is how the government uses taxes and spending to manage the economy. During economic ups and downs, like recessions or booms, the government adjusts these policies to help stabilize things. For instance, in tough times, they might cut taxes and spend more to boost the economy, and in strong times, they might raise taxes and reduce spending to prevent inflation. Fiscal policy aims to keep the economy running smoothly and avoid extreme swings in economic activity. Fiscal year. A fiscal year is the financial accounting year that a company uses for its financial reporting and record-keeping, which may not necessarily align with the calendar year. Some businesses choose different fiscal year periods based on their specific needs. For example, a department store may find it more practical to end its fiscal year on January 31st rather than December 31st because it allows them to include the financial results of the busy Christmas shopping season. Fixed asset. A fixed asset is a long-term, tangible asset like land, buildings, or machinery that a company holds for its own use rather than for sale or conversion into cash. These assets are an essential part of a company's operations and are not intended for immediate resale. Fixed assets are reported on a company's statement of financial position, also known as the balance sheet, as they represent the value of assets owned by the company that are expected to provide long-term benefits. Fixed dollar withdrawal plan. A fixed dollar withdrawal plan is a financial arrangement in which an individual who holds an investment fund specifies a fixed dollar amount to be withdrawn from the fund at regular intervals, such as monthly or quarterly. This plan allows the investor to receive a consistent and predetermined income stream from their investment over time. The fixed dollar amount is withdrawn regularly, regardless of fluctuations in the fund's value, which can provide a predictable source of income for the investor. Full replication. Full replication is an investment strategy used by exchange-traded funds, ETFs, where the ETF holds all of the individual stocks or securities included in a specific benchmark index. These stocks are held in the same proportion and weight as they are represented in the index. The goal of full replication is to closely replicate the performance of the benchmark index with minimal tracking error. Full, true, and plain disclosure. This principle mandates that companies and individuals issuing securities in Canada must be completely transparent and forthright in providing information to potential investors. They are required to disclose all pertinent details, risks, and financial information related to the securities they are selling. This is done to promote fairness, protect investors, and maintain the integrity of the securities market. Fully diluted earnings per share. Fully diluted earnings per share provides a more conservative and comprehensive view of a company's earnings on a per-share basis. It accounts for the potential increase in the number of common shares that could result from the conversion of various securities and options. This metric is often used by investors and analysts to assess a company's financial performance while considering the potential dilution of existing shareholders' ownership due to the conversion of other securities. Fundamental analysis. Fundamental analysis involves studying a company's financial statements and assessing the broader economic context in order to determine the intrinsic value of a security. This approach is used by investors to make informed decisions about buying or selling investments based on their analysis of a company's fundamentals, such as its revenue, profit margins, debt levels, and market position. It is often contrasted with technical analysis, which focuses on price patterns and market trends. Funded debt. Funded debt refers to all of a company's outstanding debt instruments, such as bonds, debentures, and notes, that have a maturity date of at least 1 year from the current date. In other words, it encompasses all the company's long-term debt obligations that will not become due and payable within the next 12 months. Fund facts. Fund facts is like a condensed summary of key details about a mutual fund, presented in a clear and easily understandable format. It covers important information such as the fund's investment objectives, past performance, risks, fees, and other relevant factors that can help investors assess whether the fund aligns with their investment goals and risk tolerance. It serves as a valuable tool for investors seeking transparency and clarity when considering mutual fund investments. Fund of hedge funds. A fund of hedge funds is like an investment fund that spreads its money across multiple hedge funds, allowing investors to diversify their exposure to different hedge fund strategies and managers. The fund manager takes on the responsibility of selecting and monitoring the underlying hedge funds, aiming to create a diversified and potentially more stable investment option for investors. Futures-based exchange-traded fund. Futures-based exchange-traded funds, ETFs, are investment funds that primarily invest in futures contracts linked to various commodities. These ETFs hold a portfolio of money market instruments to cover the total value of the futures contracts they hold. To manage their investments, they periodically roll over near-term futures contracts into contracts with longer maturities as the near-term contracts approach expiration. As we wrap up this session, we're thrilled to have embarked on this journey together, exploring the foundational terminologies crucial for acing your financial certification exams, including investment funds and Canadian securities. If you found our insights valuable, remember to show your support with a thumbs up and extend the knowledge to your fellow learners. We trust that these insights will prove indispensable on your road to success. Stay tuned for more enriching content, and remember, your financial expertise is just a click away.